Hey guys, my name is Austin with My Easy Mortgage. Wanted to talk about, you know, credit scores. Talking about your mortgage score, talking about, how you can maybe improve this, what factors they're looking at. You know, Almost every client that comes in, they'll show up with, what their Credit Karma score is, or their Experience score, or one of these other consumer websites. And 100 times out of 100, it's going to be different than what your actual score is going to be. And the reason for this is they're looking at obviously the same report, looking at the same information, but the weight at which they hold certain factors on your mortgage report compared to your consumer report are going to be just a little bit different. And I want to talk about the three main factors when it comes to your mortgage score. And so first of all, I'll talk about the 6 factors that they use. It's going to be payment history, age and type of credit, percentage of credit limit used, so your credit utilization, total balances, recent credit behavior, and available credit. The 3 most important factors are going to be your payment history, your the age and the type of credit you have, and also the percentage of your credit limit used, so your credit utilization. So about 40% is going to be your payment history, and this is just basically looking at your last 3 to 6 years of different accounts, different credit cards, different student loans, different types of installment debt like car payments, and just making sure you're making those monthly payments on time. They like to see a wide variety of different accounts in your report. This is about, like I said, about 40% of what your score is going to be. So this is a major factor. And, this is something obviously you can't really control in the short term, as far as fixing in the short term. This is just something that's kind of in your history. But the one thing that you can maybe control to help your score in the short term, if you are looking to apply in the next 3 to 6 months, is your credit utilization. And there's a lot of myths around this, but, an ideal situation would be to have a few different credit cards, have a decent credit limit on these cards, and however, not having a big balance on these cards. So you want to really stay below 0 and 5% on the balance. So for instance, let's say you owe $1,000 in different credit cards, and let's say your total credit limit is $2,000. That's 50%. Okay, so that's not going to be a very good number when it comes to your credit report. You want to, like I said, ideally be at 0%, but if you can stay in that 5 to 0%, you're going to have the best score possible. So, let's say your credit limit is $20,000 and you owe $1,000. That's about 5%. That's going to be a pretty good factor in your mortgage score. They want to see some different accounts in there as well. So I always say, if maybe you have a credit account that you never use, there's no balance, you just want to close the account. If you are going to apply for a mortgage soon, I would definitely not recommend doing that, because that doesn't look good either if you have a lot of closed accounts on your credit report. So, in the situation where you are looking to apply for a mortgage, I would, keep that card, keep it at 0. And, this will help you when it comes to applying for a mortgage. But, as I said, the 3 other factors that are probably more important in your consumer report than your mortgage report are going to be total balances, recent credit behavior, available credit. So as far as total balances go, this is just basically looking at the all your installment debt together, seeing what that number is. I'll say, for instance, I've seen some student loan debts be, $300,000, $400,000. They're about a year old, but the person's they're making their monthly payment. The rest of their credit report looks good, and even though that balance is so high, their score I've seen still be in the 800s. So this is not as big of a factor as you may think when it comes to your just getting your credit score. Recent credit behavior. This is about 5%. You don't want to be opening up credit cards and opening up different accounts, getting different loans, a month or 2 before applying for a mortgage. But another myth is, if you do apply for a few different mortgages, you get a hard pull, it's going to drastically decrease your score. I mean, this might drop you 1, 2, maybe 3 points at the most. And even if you're applying for 4 or 5 different mortgages, after a month they're going to realize you are just applying for mortgages. So that's not going to hurt you. 4 of those are going to go away on your report after a month, as long as the credit bureau realizes these are all for applying for a mortgage. And the last one is available credit. But this kind of ties into the credit utilization as well. So to have a high credit limit, very high credit limit is not necessarily a bad thing. That can be a good thing as long as your utilization is low. So these are just some brief things I wanted to run through. If you do have any other questions, I'd be happy to help. My name is Austin with My Easy Mortgage. Thanks.